28-36 rule. The 28-36 rule is a simple guideline lenders use to figure out whether a mortgage payment is affordable for you. The first number, 28, refers to your front-end ratio, meaning no more than 28% of your gross monthly income should go towards your total housing costs. That includes your mortgage payments, property taxes, homeowners insurance, private mortgage insurance if you need it, and any HOA dues. The second number, 36, is your back-end ratio. That means no more than 36% of your gross monthly income should go toward all of your debts combined, so your housing costs plus things like car loans, student loans, and credit cards. It's not a law, but it's a well-respected benchmark in the mortgage world. Is the 28-36 rule required to get a mortgage? No, it's more of an ideal target than a hard rule. Conventional lenders often stick close to it, but government-backed loans like FHA, VA, or USDA can be more flexible. FHA loans, for example, sometimes approve borrowers with back-end ratios over 40% if they have strong credit or extra savings. So while you can still get a loan above these numbers, the 28-36 range is considered the safe zone for keeping your payments comfortable. Does the 28% include utilities? No, that 28% only includes costs directly tied to owning the home, so your principal, interest, property taxes, insurance, and HOA fees. Utilities like electricity, water, internet, and garbage aren't factored in, but you'll still need to budget for them. That's why some people aim for less than 28% to leave extra room for those monthly living expenses. Should I follow the rule if my lender says I can afford more? Most of the time, yes, you should still follow the rule. Remember, lenders calculate these numbers based on your gross income, not what you actually take home after taxes and deductions. Just because a lender says you can go higher doesn't mean you should. Sticking with the 28-36 range gives you breathing room for savings, home maintenance, and everyday life instead of putting every extra dollar into your mortgage. What happens if I'm over those limits? It's not an automatic no, but it can make things harder. You may get fewer loan options, pay a higher interest rate, or face stricter terms. And from a personal finance perspective, it could leave you with very little cushion if something unexpected happens, like a job change or a big repair. Even if a lender approves you, you want to make sure the payment feels sustainable for you, not just on paper. How do I figure out my own 28-36 limits? It's easy. Take your gross monthly income before taxes, multiply it by 0.28 to find your max recommended housing costs, and by 0.36 to find your total debt limit. For example, if you make $6,000 a month, your housing budget would be around $1,680, and your total debt budget would be $2,160. Then compare those numbers to your actual expenses to see if you're in the safe zone.